I think we inappropriately see, the gurus online talking about how real estate is end all be all. I do believe that real estate is, in the long run, it's a good place to get involved. But I also think that with interest rates going up and house prices doubling, the cash flow from an Airbnb, which we got 4 years ago or 3 years ago, just isn't there. Man, wouldn't it be great to have money, 8 years ago to get involved with Airbnbs before it actually got popular? So number one is everybody listening to this, 98% are going to feel behind the 8 ball like they missed it. You're not unique. The worst thing you can do is dive in when you don't understand something. Here's the ironic thing about term insurance. In order to qualify for life insurance, you have to prove you don't need it. You have to prove that you're healthy. And if you're not, the insurance company's not going to insure you. Because if you owned an insurance company, would you want to be paying death benefits left and right? No, not at all. So you have to get approved for the insurance, and then if you get what you want out of life, you're going to outlive it. And so that's called pure cost. The money is gone forever, but it covered the need if something were to happen. So as a dad, I have term insurance. I want my kids to get a bunch of money if something happens to me. I want my wife to be taken care of if something happens to me. If she marries a pool boy, I want her to marry the pool boy out of choice, not out of necessity. So for all pool boys listening, I'm not going anywhere, but if it were to happen. What's up, everybody? Welcome to another episode of Cash Flow Conversations. Today I have a young buck named Tyler Armstrong, a local here in Nashville, Tennessee, who reached out to me, who heard some of these conversations in the podcast and had some phenomenal questions. We met for coffee, only 2 weeks ago.
Yeah.
But easy conversation. Tyler's a recent college grad, pretty good income from Louisville, Kentucky, living here in Nashville now. Tyler, it's good to have you here, dude.
It's great to be here. I'm excited.
Yeah, man. So we had such a good conversation over coffee. Tyler brought up a good point. He said, look, I listen to the podcast and sometimes I have to pause things because you'll talk about a theory or an idea and I don't know what you're even talking about. So I have to look it up before I can even kind of track it. And it made me think wow, all right, well, that's phenomenal feedback. Why don't we just record our conversation? So other people who are thinking the same thing, we don't talk over their head or make them pause and let them kind of start from the beginning. So I think this is a great opportunity for a young audience. So thanks for being here, man.
Yeah, for sure. I know walking in that day to get coffee, I have a baseline knowledge of everything. And I would always do my own research. I'm not a big reader. I try to read a little bit, but I usually listen to a lot of podcasts. And for me, it was expert to expert talking, any podcast that I would listen to. And I would have to pull and pick pieces out of those podcasts to do my own research on. And that's kind of what I brought up to you. I said, there's never been expert to average. And
yeah,
so I'm here to ask those average questions.
It's funny because I don't even consider myself an expert by any means. I'm well-versed in a couple of topics, but I'm more curious than anything. And I think if you can live a long life and never give up curiosity, I think you'd be fulfilled for a long time. But I don't think expert is something that you ever actually attain. So thanks for the kind words. So yeah, man, let's start off. Graduated college. What you're doing, kind of like medical sales now, right?
Yeah. So I do predominantly bracing and power mobility. So those older people that you see driving around in their motorized wheelchairs and scooters and stuff like that, I do a lot of that. I do a lot of back bracing, but then of course your knees, your ankles, your wrists. So I'm going around day in, day out, different doctors' offices, hospitals, talking to them about their patients, selling a little bit, but it's more really just having conversation with doctors each day, and then the sales come in after that.
Hitting the pavement, I love it. The fastest way, in my opinion, the fastest way to wealth is increasing your income. It's your number one asset, especially if you're young. Gosh, if you're old, you better figure that out sooner than later. Otherwise, you're going to put it all on black and go to Vegas, Right. That's high risk. I don't want to do that. So yeah, dude. So you're doing the right things in the right, getting in the right circles. Medical sales. I mean, there's really not a ceiling in that industry either. It's not easy. It's pretty cutthroat. Right. But you can make a lot of money doing that.
For sure. That's the one benefit when I explain to people about my career choices. I could have went and worked an office job and have that ceiling, but with this, I have that base pay, but my ceiling is truly endless. I do think within certain cities around America, like if I was in Nashville, it could be a little bit different, but especially being in the territory I'm at, working all of Middle Tennessee, I have a extremely high ceiling, so I'm looking to capitalize on that. And then
beautiful.
Kind of what brought me to you is, okay, once I reach that high ceiling, what can I do with it to make my money work for me versus work against it, if that makes sense.
Yeah. Yeah. And for everybody listening, my thesis on this is that, once you take care of your income, which I think is the harder part, the riskier part, your money should be placed in a place that's safe first. And as a family man, my money goes all into life insurance by a really big death benefit that's guaranteed for my family, income tax free. So I cut out the IRS. I fund whole life insurance where I have guaranteed growth. It's not phenomenal growth, but it's stronger than inflation typically. And there's guaranteed no loss. And it's also protected from creditors in the state of Tennessee. That's a state by state thing. So I take care of my family. I stuff my money in a place where creditors and the IRS can't touch it. And then I leverage that cash value over and over again before retirement years into stuff that I want to invest in, that I can enjoy, that generates cash flow long before retirement years. So that's kind of like what I talk about all the time. And that was a quick intro for anybody new. So what did you hear exactly though, Tyler, that kind of prompted you to reach out? Was there like a specific conversation or like a topic?
I would say it was more just the topic in general. Growing up, whether it be my family or just surrounding families that I was super close with, it was a big Dave Ramsey style.
Yeah.
And then just through social media, through podcasts, through learning, through books, everything, I was kind of introduced to this new, I guess, planned strategy and with whole life. And again, I don't know everything. I'm slowly learning as we go, but that's kind of what started like my curiosity and what started me reaching out to you and having conversations with you, because I was raised in this area and now I'm learning this area, and I'm super interested in it. So
love it, dude. So Dave Ramsey doesn't do bad stuff. I think people kind of get a limit though when they listen to him. They're like, okay, now what's next? Because Dave does really good of helping people not outlive their income or outspend their income, right? Like he's all about getting out of debt, but he's so negative about debt. I think it's a detriment to the society when he says never go into debt, when there's ways that you can use other people's money very conservatively to get ahead. And he will tell you that there's too much risk involved and that you can't calculate that. I would argue that all day long. I wrote a book years ago. There it is. Don't be debt free and broke. And the idea is about, like, we're taught to pay off this debt, but what about access to cash if I need it? Dave will talk about $1,000 emergency fund. What about a $50,000 opportunity fund? What if I could be solvent instead of debt free? And so that's what we teach. And life insurance, I have so much confidence. Everybody says, why do you have, how can you be confident about this? There's no loss. So I use life insurance because it's guaranteed never to go backwards. And then if I want to expose it to risk, I can take calculated risks and things that I know and like business and real estate. So let's start from the top, man. I mean, I know you had a list of questions when we sat down for coffee. So I'll let you kind of start off.
For sure. So diving into just the whole life, I hear all the time about like specially designed whole life policies. For me, I don't know if that is specially designed to the person, to your financial situation. So one of my biggest questions that I had first sitting down with you was, what does that mean and how can it be helpful to me?
Dude, this is why we need to be on a podcast. Good question. So, and I have a client who's a good friend of mine who called me this week and said, hey man, I had another advisor just like look over my stuff, and he reviewed the policy and had all this negative to say. And then I read the review and the other advisor doesn't even understand it. So it's not to say that other advisors don't know what they're talking about. It's just that, look, there's specialists in there. I don't want a orthopedic doctor to give me heart surgery, and that's okay. I just want to focus on life insurance. So when you say, how do you specially design it? There's a million ways to design policies. So for someone who's young in their 20s, access to cash is really important early on. So we want to make sure that it's considered overfunded with riders that allow you to have access to that cash. We also want to use companies that have flexible premium options. So if you have a good year, you can dump a bunch of money in. And if you don't have a good year, you're not required to. There's a flexible, and this is a massive misconception in the market where, whole life insurance, you have to pay premiums your whole life. Not even true. Whole life insurance, the premium is the premium and it's got to be there for the rest of your life. It's not true. you could have a corridor of a minimum and a maximum that you're allowed to put in each year. So you want the flexibility for a younger person. And then you can stop those premiums, after 7 years, pretty much whenever you want. Contractually, you don't have to keep paying those things. And we designed that up front. So for someone who, might be 55 or 50 years old and they only have 10, 15 years where they want to fund a policy, we would be probably more interested on the back end cash flow that a policy could give them in retirement years, not putting money in, like someone who's 25, putting money in and then pulling it right back out to go buy my car. Okay. So does someone want early cash value? Do they want later cash flow? Or, there's a third option too. Is this an estate play? Is this really meant to take care of estate taxes at death? In which case the death benefit's really important. So I am so careful to say absolutes, like all policies or everyone. And, I say a lot of people sometimes, maybe incorrectly, but you got to stay away from absolutes when it comes to the financial world. There's very few absolutes, like everybody needs to do this, other than I believe if you can, everybody should have life insurance in place. That I do believe that if you're healthy enough to get it, you should have that. But the design is all custom based on who the client is, how healthy they are, and what their goals are. Because here's another thing, dude. You get someone that goes through underwriting and it's not very favorable. Well, now all of a sudden we're not planning for a life to live to age 93. Their life expectancy might be in the 60s or 70s. And that changes the game plan. Either they can get on a health kick and where they can kind of hopefully get healthier so that it can improve on that timeline, or we're just not going to plan as long, in which case the death benefit and long-term care, those issues now are much more important. So these are so customizable. And it's funny, dude, because you make a post online and how do you have enough, in a 90-second clip, you're going to get these keyboard warriors always talking negative about it. It's like, that's not what I mean in that instance. But,
right. Well, that's a good segment into my next question, because I see these posts, whether it be TikTok, Instagram, whatever it may be. And it's kind of a very, like you said, a 60-second summary of the positives of whole life. And then you have people coming into the comments saying term's better, right? Mm-hmm. Growing up, like I said, that's a lot of what I heard, term over whole life. So from a general basis, what would be the difference? And then I guess my second question to that would be, why would someone rather do whole life than term for their specific financial situation?
There's so much to say there. I'm going to give you the easiest answer. As a parent, which I know you're not in that position, as a father, not yet. Yeah. As a father, I want to make sure that my spouse and my kids are taken care of if something happens to me. Before I care about rate of return. My oldest saying is, I don't care how much money you're worth. I care how much you could lose. Whether it's creditors, Wall Street, or if your income stops because you're gone. Like, what happens to your family? Like, protect yourself first, okay? Then get really courageous. So there's what's called a human life value. So if I make $100,000 a year, easy numbers, let's say and something happens to me, I want my wife to be taken care of. Mm-hmm. So I would take the 100,000, multiply it by 20. Now I'd get a $2 million death benefit. Whole life, term life, I don't care what kind of policy. My family needs $2 million of death benefit, because if I died, she theoretically could put that into an annuity and get 5% or $100,000 a year every year for the rest of her life. Okay, so it replaced my income. That's what insurance is. Right. If you wreck your car, you want your car replaced from the insurance company. Now, if I wreck a Honda Civic, they're not going to give me a Ferrari. Same thing with life insurance. My human life value is based on my income and net worth and things like that. So first of all, you need a death benefit. Then how do you want to pay for it? Well, the easiest way, the least expensive, is called term insurance. You pay premiums for a term period of time. And after the 20 years or the 30 years is up, the term policy goes away. And all of those premiums are kept by the insurance company. Okay. Here's the ironic thing about term insurance. In order to qualify for life insurance, you have to prove you don't need it. You have to prove that you're healthy. Right. And if you're not, the insurance company is not going to insure you. Because if you owned an insurance company, would you want to be paying death benefits left and right? No. No, not at all. So you have to get approved for the insurance. And then if you get what you want out of life, you're going to outlive it. And so that's called pure cost. The money is gone forever, but it covered the need if something were to happen. Okay. So as a dad, I have term insurance. I want my kids to get a bunch of money if something happens to me. I want my wife to be taken care of if something happens to me. If she marries a pool boy, I want her to marry the pool boy out of choice, not out of necessity. Okay. So for all the pool boys listening, I'm not going anywhere, but if it were to happen. And so I would start with term insurance. And then as my income allows, I would convert that into what's called whole life because I want the cash value component. At the end of the day, if you look at retirement strategies, death benefit plays a huge role in retirement income. And what Dave and a lot of those other people talk about is you'll be self-insured. You'll have enough money, you don't need insurance. Dude, if someone else could pay for something, why wouldn't I let them? I'm so cheap, I don't want to give my kids my money when I'm dead. I'm going to let the insurance company pay them when I'm dead. If I need long-term care, I don't want to go into a home. I want care in my house. I'm going to let an insurance company pay for that. Why would I want to get rid of those benefits at the time that I need it the most in my 60s and 70s? And so the problem is when you meet a 60-year-old, they're like, well, it's too late. I should have done this 20 years ago. Maybe, but when's the best time to plant a tree? Today. Or yesterday. When's the second best time? Is today. Mm-hmm. And so you can get both of those. So first is the coverage. The first answer is like you make sure you get coverage. So for a young person like you, dude, I'd be buying as much term insurance as I could because that term will never change for 20 years and your health is locked in for those 20 years. So you could get cancer and diabetes and you still have term insurance that's at the really good rating when you were 25 years old. And then when you convert it with cancer, you stay at the old rating. You don't have to go through medical underwriting again. So buy as much term insurance as you can while you can. And then as your income goes up, you just buy more and more. And then when you start making more money, you have more savings. I want to get money out of the bank where it's exposed in lawsuits, where you get a horrible rate of return, where I get no benefits, where it's taxable. I want to stuff that money into a policy and then start to research what kind of investing I want to get involved with. And then I would leverage that cash value from whole life to go do all that.
Now, speaking of investing, so you have your money in the whole life policy. You can borrow against that policy, correct?
Yeah.
And that's how you get the money out to invest into an asset.
Yep.
Now,
there's two things here because keyboard warriors are going to chime in. You can borrow it, and yes, you're going to pay an interest rate. They're going to charge you an interest rate. You don't have to pay it. Or I can surrender it, which means it's a bank, dude. You just go take a withdrawal. So I could withdraw it just like the bank, or I could borrow it. I get to choose at the time when I want to take the money out. And most of the time it makes sense to borrow it. But, you make that decision when you do it. So I want to make that clear really quick.
Right. And then now, correct me if I'm wrong. I may have heard this, but this is why we're having this conversation. So if you don't pay back yourself from what you borrowed against, it comes off the death benefit, correct?
Yep. So this is a great way to look at it, dude. Related to real estate. In real estate, my house is worth $500,000 and I have a $250,000 loan. The equity is equal to the amount of cash value in a policy. Okay, so if I have a $500,000 house and and $250,000 of debt, I have $250,000 of equity. In life insurance, I'd have a $500,000 death benefit, and I could have $250,000 of equity.
Okay.
If I were to take the cash value out of the policy and die, well, my wife gets the 500 minus what I already took out, so she'd get the 250. So it's a loan that's repayable when you're dead. In a house when I do real estate investing, if I borrow against a house and I don't make loan payments back to the lender, the bank will take the home.
Right.
When I borrow against my life insurance, I'm borrowing against, here come the keyboard warriors, I'm borrowing against the death benefit up to the amount of cash value. The cash value is the equity, the death benefit is the overall value of the house. And Dave will sit there and tell you that when you die, you don't get the cash value, that money's gone. It's so incorrect because as the cash value grows, it's buying more and more death benefit. So what I put in place today has nothing to do with what's going to be in place 10, 20, 30 years from now. It's going to continue to grow as I fund it more and more. So ideally, I get to spend my money 2 to 3 times. So if I put in, over my life, I put in $1 million, ideally I could take out, 1.8, 2 million to live on tax-free, and my family would still get a bunch of money tax-free after all that. Yeah, so I'm borrowing against my dead self when I die.
Right.
And if I don't pay it back, it just comes off of that the leveraged asset, which is the death benefit.
And I think that that clears up a lot of just general confusion. So I do think that, it's myself included, especially when getting introduced to these strategies and these kind of conversations, a lot of people I feel like just don't really know
No.
the full story to it.
Well, they don't. Here's what's so funny, because people out in the universe talk about how the commissions are so high on life insurance. They can be, but have you ever added up the fees on a pre-taxed retirement account? Look, if someone wants to make money in the financial industry, you make a killing managed pre-taxed retirement accounts, charging fees on accounts regardless of the performance on dollars that the IRS haven't taken their fair share yet. Okay. The money, knowing that the consumer might have $1 million, the advisor gets paid on the $1 million account balance. If the consumer to pull it all out, 30-40% goes to the IRS. The consumer only might keep 600,000, but the advisor is getting paid on the full $1 million. And then they complain about insurance commissions. Anybody who talks about that has never done a calculation on fees versus commission. And here's simple proof, dude. On Netflix, can you buy Netflix and be done? Like just a one-time purchase?
Not that I know of.
No, you can't even buy Microsoft products
Right.
on a one-time. It's a subscription model. It's what Russell Brunson calls the linchpin. If you know what that, any marketers out there, that they know what that means. It's the monthly fee. There's more money in monthly fees and reoccurring fees than there is in a commission. Very simple. Unless someone dies right away, in which case there'll be another advisor for the inheritor. The inheritance, whoever inherits that money will be paying the fee forever. But commissions are much less than an ongoing fee, and it's simple to understand why. Because fees are justified because they're in a volatile market where the money can go up and down. So the justification is, well, we're going to manage that for you. Very seldom is there actively managed portfolios. Most retirement accounts are passively managed. They're put into a fund, set it and forget it, a retirement target date. There's no trading that goes on, and they still get to charge fees.
So, from my average world, as I worded it earlier, when retirement comes up, 401k always is in there, right? And I thought you had a very, I say unique because I haven't heard it often, right? But I also was super interested in your opinion on 401ks and just everything that has to do with it, everything around it. So,
Yeah.
bluntly, what's your opinion on 401ks?
Oh man, it's just us here, right? No one's listening. It's just us. Well, between you and I as a friend, I think 401. Here's my PC answer. I think 401ks are really good for the majority of Americans because it allows the employer to participate in the retirement strategies of a employee. A 401k can be a good thing if it's a really solid match. So some people will say, yeah, if I put in 5%, they're going to put in 1%. That's not a good match. If the client puts in 3% and the match is 6%, that's a really good match. And so I'm all for it. Go do it. Go do it. The challenge comes from people putting all their eggs in that basket and being very passive about, well, it's all, I got a 500 grand in there, it's going to go up and that's my retirement. Okay. Have you calculated how much you're going to keep? So in other words, you have $500,000 in a 401. How much of it is yours? Nobody knows.
Not that, yeah.
Because you're not going to take it out. So then the question is, all right, do you want to make more money as you get older? Tyler, do you want to make more money when you get older?
Of course.
Where do you think tax brackets are going to be? Higher or lower?
As I'm older, higher.
When has the government helped wealthy people? I mean, right now you got AOC with a dress that says tax the rich. And if you have millions in a pre-taxed account, guess what? You're considered rich. They don't calculate rich people based on net worth. It's based on income. And a 401k triggers ordinary income taxes when you go to retire. So these people, without even thinking about it, are postponing a tax bill in a time where they have kids, a mortgage, and true deductions. They're delaying a tax bill to a time they can't even calculate what the tax rate will be. When all their kids are moved out and the house is paid off, and the money that's coming out is 100% ordinary income, and we can't even calculate the rate because we don't know who's going to be in office. And then it triggers Medicare tax and Social Security tax and state taxes, and your advisor's still getting a fee. So great, you have a bunch of money in an account. You have no idea how much you will net from that account.
Yeah. And
but it's passive, bro, because look at the end of the day, I got $1 million in my 401 and you only have $500,000 in your life insurance. Okay. Bigger numbers, that's better, right? I mean, how stupid or short-minded could you be to say bigger number, that's better? How about this? Take it out and bring it to the office. You won't do it. Nobody will. I'm going through buying a house right now. They don't give a crap about net worth. They care about cash flow, income, and liquidity. They don't care about net worth. Don't care what's in your 401.
I'm so glad you said that word, cash flow. Growing up, I feel like everyone wants to be rich, right? They want to have that high net worth. And recently, I just hear more and more about cash flow over net worth, right? Can you cash flow enough monthly to cover your, whether it be like expenses just to survive, expenses to live the lifestyle you want to live, all of that, versus net worth? What is your difference between the two? And I would assume you value cash flow more. I'm learning to value cash flow more. And why is that?
Ask a bank. When you go to buy a house, they're not going to care about your IRA or 401k. They're going to care about your income or cash flow. Mm-hmm. They're going to care how much is in your bank account. Why? Because you can go pull it out tomorrow if you needed to. Here's why they don't look at a 401 or an IRA, even a Roth for that example, for that instance. It's still government controlled. If I have $500,000 in a 401 or an IRA, I can't pledge it as collateral. The bank doesn't care about it because they know that I'm 40 years old. And if I were to pull the money out, I'm going to owe a 10% penalty. I'm going to owe the income tax that's due on top of that. I might net $300,000. Plus, the market could go down tomorrow. They don't even know how much it's going to be worth. So they say, we're not even going to look at that asset anymore. Oh, but you make, $1,000 a month from a rental. We'll count that. That'll help you be able to make a move with us, because the banks are smart. They know it. They just don't teach this stuff, because if they taught us how to be independent from banks, we wouldn't use the bank. Right? If the bank taught us how to go around them, they make themselves obsolete.
Yeah.
This is why the pharmaceutical industry exists, but we won't go into that today. They want you. They don't want you dead. They want you sick.
Right. So I feel like I'm just bouncing around. You can corral me in if you'd like, but again, when I approached you and we had coffee 2 weeks ago, that's where my mind was. I was bouncing around asking all these questions. So
yeah, no, dude, this is great stuff, man. This is great.
I also hear a lot about compound interest. Yeah. I hear mixed things about it though. I hear people say, it's the best thing ever. I've heard I don't remember what the quote was or who it's from, but like the eighth wonder of the world or something like that. I think it was Albert Einstein, if I remember correctly. But then I hear people kind of go against that and say compound interest isn't all it's hyped up to be at certain times in certain situations. So I think for me, the average person, the average knowledge baseline that I have with financial things as a whole, like where is your opinion on compound interest? And
this is why I like, this is my podcast and I get to give my opinion, because objectively speaking, I could answer a couple of different ways, but I'm just going to give you my opinion. If you think compounding is not good, then you're an idiot. You don't understand it. Without a period, with a comma, if you think your stock market account, your in Wall Street account, whether it's IRA, Roth, after-tax, stock market account is compounding, you're equally an idiot. And so people will say, put money in your account now, because compounding, at 25, if it keeps compounding by the time you're 60, you'll have a ton of money. Look, hopefully you'll have a lot more money by the time you're 60, but it's not compounding. If your account can go backwards, it doesn't compound. It could go grow. And then when you turn 60, it could go down 20%. Didn't compound. So when people say, and when I started out, I used to have friends that, I was in my 20s. Man, I'm just going to go do a Roth because I'm going to keep putting money in. If it averages 10%, I'm going to have all this money. Dude, if the stock market worked like a calculator, you would have a lot more wealthy people walking around today right now. How many people that 30 years ago should be rich by now?
Well, I wasn't alive 30 years ago, but I get the road you're going down for sure.
Yeah. Like our parents would be a lot better off if the market worked like math.
Right.
So so I do believe in compounding, and it's not something to believe in. It's a true thing. And life insurance, as far as I know, is one of the only thing that is guaranteed to compound over your entire life, even when I pull the money out. Because let's say that you do the stock market, you're stupid enough to, I'm getting drastic here, I don't care, it's my podcast. You're stupid enough to believe that the stock market's going to compound. When you go to retire, you're pulling money from the account. So by definition, you're killing that compounding, aren't you? Well, if I can borrow against an asset, it can continue to compound as if I never touched it.
Right.
That's life insurance. It's also real estate. I can, like mine, I'm going to have a new shirt made. The next round of shirts, it's going to say, buy, borrow, die. Never going to sell the asset. I'm going to borrow against the future value. Going to generate cash flow. And my kids get a step up in basis on real estate specifically. Kids get a step up in basis when I'm gone. Just going to borrow against the asset. You think Elon Musk bought Twitter with after-tax dollars? Go like this. It was debt. He borrowed against it. So if I can set my accounts up to compound forever, life insurance, I don't have anything to worry about other than what am I going to do to control it? And now what I realize is that I don't have to try and keep up with the Joneses. What do I want? What kind of real estate does Matt want to get involved with? Or what kind of real estate does Tyler actually want? You might not know the answer to that yet. And guess what? That's okay. That means you're just not ready, which is fine because the life insurance is going to grow no matter what. Keep building the income and eventually you're going to have an opinion like we do now. Me and my wife, I want to get a couple of rentals on the beach, in the mountains, on a lake.
And I might
in that order.
I might rent from you from each one actually.
Yeah, dude. Because now my 401k is actually a 401 cottage. Okay. And if you go to 401cottage.com, there's an ebook you can download. It's free. But the idea is that instead of just statements, I can actually get keys to go visit. Instead of stress from the stock market, I can get memories with my girls hanging out on the lake or on the ocean.
Mm-hmm.
Instead of tax deferral in a 401, I'm getting true tax deductions inside of real estate. And I'm hedging my money against an asset that historically has done phenomenal because it's finite. The real estate, there's only so much real estate. They don't make any more of that. So I'm going to hedge. My bet is I think people want to sleep inside 20 years from now. Something in my gut is telling me that they're not going to want to camp all the time. And if they can sleep inside on a lake, a beach, or in a mountain, I think the value is going to go up.
For sure. So something you said within that was, it just makes me picture, I think it was a graph that I see. It has to do with whole life, and it's a constant swoop, right?
Yeah, exponential curve. Remember algebra? I failed that 3 times, man.
I don't remember any of that, to be honest. That's why I call it a swoop. But you save, there's little steps. Basically, you save, and then it drops, and then you save, and it keeps going. And then it compares that chart or that graph to with whole life, right? Yeah. And so it's constantly going up, even though you're borrowing against. And I think seeing that, just being a visual person and seeing that graph really is what started everything. I was like, oh, if I could get this and then keep growing versus save for it and then get this and then have nothing, that changes the game.
Yeah.
Especially it changes the game for me maybe a few years from now or in the future, near future, with real estate or investing in assets that produce that cash flow. So
you're exactly right. So the graph, the first time I saw it was done by Don Blanton. He started Circle of Wealth, really successful financial firm, and coaches a lot of advisors. He calls that the wealth creator line. And to your point, it starts off with going into debt and then just paying it off, and you never actually get money. Right. And then he compares it to what Dave Ramsey would say is pay cash for everything. Save, and then pay cash back down to zero. Well, what if I save in an account that's compounding better than a bank? life insurance, and I can leverage it, not pull it out. I can borrow against it, not borrow from it. And so it allows the compounding curve to be uninterrupted.
Right.
And then I just put it back. And yes, you'll have an interest rate. So as long as I can earn better than 4 or 5% in an investment, then then it makes sense to go do that. And another one could argue, and this is where the infinite bankers come in, I'm going to pay a lender an interest rate if I go borrow money to buy a car. If I pay cash to buy a car, I'm losing interest that money could have earned. If I start life insurance that's compounding forever, I'll pay the insurance company back the interest that I would have given the bank. I'm paying it to the insurance company, but the insurance company doesn't recognize my loan and it continues to compound forever. So now I have more cash. That's simple math.
Right. I'm in a unique situation right now with my company. We had a long story short, we have company cars. At some point, they're kind of doing away with that. And I have my old car that I'm going to just
Your
kind
Mercedes? The Mercedes?
the old Mazda, driving that, until the wheels come off. But then at some point in the near future, I'm going to be looking to get a car. So let's say I was a little ahead of where I am now. You could use kind of what you just said instead of save, buy a car, and I could use what you were just talking about with that.
Yeah. So let's talk about your first question, policy design. So for someone like you who's kind of getting started out, doesn't have a lot of assets yet, but knows that there's a purchase coming up soon, dude, we'd start a little policy where maybe it's a $2,000 a year premium.
Mm-hmm.
Maybe you dump in 20 grand in the first year and you have access to about $16,000 right away. It's probably about 17.5. I don't know exactly. And then you use that cash to go buy the next car, and you would continue then to pay yourself back. And so then by the time the car, by 2-3 years down the road, when the car is paid off, you'll have even more cash in the cash value than you would inside of the bank. And by the way, nothing even says you have to wait till the loan is completely paid off. The insurance company doesn't recognize the loan. So as you have more and more cash value, let's say 2 years from now, you want to buy a ring and you put in 30 grand, you bought a car. Now you got like 10 grand left. Maybe you pull out 8,000 to go buy a ring. And then you keep putting, so you use the money over and over again. Another thing that bugs me is people talking about like retirement accounts. This is why I don't like working with retirees. One, how do you know you're going to get there? Two, what's your life look like when you get there? And three, if you're really gambling on, and I'm going to say gambling on that your 401k is going to be your sole source of income, good luck. Goodbye. Good luck. Like, not many people turn 65 and hang it up and never work again. They're going to get bored. They're going to be a consultant. They're going to do something. Yeah. So now you're just compounding income taxes too, which is crazy in retirement. It's just nuts. So without getting on a tangent, yeah, dude, we would kickstart a policy for you that has a bunch of early cash. Mm-hmm. And then we would talk about what kind of budget you have to put in, and then what kind of budget you have to go buy the car. And then you have more than you would have had. Yeah. By how much? Probably not a lot, but in 10, 15 years, yeah, that is going to be substantial.
Okay. So that kind of leads me to another question that I thought about when I left you the first time we met. And it's whether it's me or anyone listening or anyone just curious, what's that first step? Like, how do they get to the person who can help them create that policy that they need to get?
Well, for anyone listening, click the link in the bio, go to cashflowarchitects.com, set up a phone call. It's easy and free. Literally, it comes down to applying. It's that simple. There's no cost. There's no obligation other than you got to do a medical exam. And dude, I was telling you, for a guy your age, you might even be able to avoid a medical exam. Just answer some questions like about family history, and that's it. Yeah. So you go to my website, you set up a phone call, or we'll do a Zoom call. I give you an application. We'll learn a little bit like to figure out which company we should go to. And then I get your information. You fill out an application. It takes about 10 minutes. Send it to the underwriter. If they want an exam or not, it's 50-50. If they do want an exam, there's no cost. Examiner comes to your house. You pee in a cup. They take your blood, answer a couple of questions. 20 minutes later, they leave. All that information goes to the insurance company. I don't see any of it. Thank goodness. I'm not a physician. I don't want to know anything. And then the insurance company comes back with an offer. And then we look at the software. We just plug in, here's what you have. Here's what you're approved for. What do the numbers look like? And I call that the design meeting. That's the fun meeting. Like, that's when we go, what if and we can plug it into the software and run different scenarios.
And so that's the step where that specially design comes in.
100%, dude. And so it's it's not like an investment where you have a meeting and then design a policy.
Right.
The problem is I don't know if anybody can get insurance. Like you have to get approval. Otherwise, I'd be sending quotes out to everybody left and right, which is worthless. It's a waste of time. So for me, if you want me to commit my time, you're gonna have to commit to going through the application process. You know what I mean?
Yeah. So one big question that I have left before just the bits and pieces questions that I had for you is student loans.
Ugh.
I asked you a question when we got coffee, and
Uh-oh.
you kind of opened my eyes, and it made so much sense. And I've told many people actually since you told me.
Well, shit. Hopefully you remembered my answer because I don't know what I said.
Well, I do remember it. So I kind of made the comment of, I'm just trying to pay off my student loans as quick as possible. And you said just a very basic comment. You said pay the minimum, right? Put let's say for easy numbers, you have $10,000 in student loans, right? You said pay the minimum, and you can get $10,000 into a savings account or an account, whatever it may be. And if for some reason you had to pay it off immediately, you had that money. But until then, just pay the minimum. And this is what stuck with me. You said the government's, what are they going to give you? A high five? Like nothing happens once you pay those off. And that stuck with me. And I've told people ever since you told me that. So can you explain a little bit more to me about your strategy and your reasoning behind that? Of paying,
Yeah.
not throwing everything you have at it.
Because
Good. Yeah.
if the goal is to be debt free, that doesn't just mean that I should put all my money towards the debt. It's what every financial institution out there wants you to do. It's how they make money. Doesn't help you. You're going to save interest. You're going to be broke. How expensive is it to be broke? You can't even answer that until you're in the position where you have no effing money.
Mm-hmm.
So that's what bothers me. That's why I wrote the book. It's called Don't Be Debt Free and Broke. And so institutions have known this for a long time. They do what's called a sinking fund. So if they know they have a big debt, like $100,000 of debt, instead of just throwing off the debt, and then if the company put all their money towards that debt, and then the company ran into a tough time and needed access to capital, now what? They got to go get another line of credit or go back and increase their existing line? Like that doesn't look good for the lender. They're like, nah, you look sketchy, and the company fails. What they should do then is this is why companies have sinking funds. Instead of throwing all the money at the debt, they start a side fund that can compound, grow, that's earmarked to pay off the debt at a future date. And if you read my book, the compounding, as long as the interest rates are similar, you will always do better compounding than you will paying off amortized debt, even if the rates are goofy. And I have a new book coming out too. It's called The Entrepreneur's Asset. It talks about this. If I have a $100,000 loan over 10 years at 5%, it's going to cost me $27,000. And Dave Ramsey says, you're losing 27,000, blah, blah, blah. Okay. So I got $100,000 in the bank and you're telling me I should go take the $100,000 and pay off the loan to save the 27. Yep. That's what they say. Well, if my 100,000 just earned 4, not 5, just earned 4% compounding, I would earn $48,000. So what's more expensive? 28,000 of interest or losing the 48 of growth?
Right.
So everyone's going to be unique. This isn't like everybody should go start sinking funds or not pay off their debt. It's like, look, just because you have debt doesn't mean you need to pay it all. And the worst thing, dude, like this is like a psyche problem, like an internal rate of return that you can't calculate. When your bank account is so low and you're trying to get rid of the debt, living on ramen noodles, I'm sorry, dude, you're not going to go kill the world. You're not going to wake up and go to the gym and inspire your friends or inspire your spouse or your kids. You're going to be so consumed with paying off the debt and you're going to live a broke lifestyle. And it turns into a broke mindset, bro. Here's something great that it's also in this new book, The Entrepreneur's Asset. What you think is what you say is what you do, and what you do becomes your legacy. If I live my life in front of my girls thinking about how much debt I got to pay off, what am I going to talk about? Honey, we got debt. We got to pay off the debt. What are my kids going to grow up thinking? What am I going to do with my money? I'm not going to go buy the bikes that they want. I'm going to go pay off this debt. I'm going to go pay off the house, which gives no cash flow. And then my legacy is my dad was frugal and we didn't get to enjoy vacations like my friends did. That's not the life I'm going to lead. So, yeah, man, debt's a funny thing. It's a 4-letter word if used incorrectly, but it's a hell of a tool if you use it the right way.
Yeah, I remember. I mean, just like I said, the first time you told me that, that clicked. It made sense, and told.
Yeah. So, and one of the ideas is like once that compounding, that sinking fund becomes a certain amount, I'll have enough then to pay off the debt, right? That's called solvency. And that's my thesis. Solvency is better than debt free. I want the ability to pay off the debt, but I want access to the capital.
Right, right. Yeah. So you did remember. That's exactly what you told me. That also is what clicked. Um, so just a couple questions bouncing around. A lot of things that I listen to is heavy on the real estate side.
Yeah.
Using that as a tool to cash flow, things like that. I wouldn't say I'm necessarily there yet, but for the people who are there, what would you recommend would be like the best way to get into that? What would you?
Yeah. So, I mean, that's a really good question because I think we inappropriately see, the gurus online talking about how real estate is end all be all. I do believe that real estate is a in the long run, it's a good place to get involved,
Mhm.
you know. Um, but I also think that with interest rates going up and house prices doubling, the cash flow from an Airbnb, which we got 4 years ago or 3 years ago, just isn't there. Um, Man, wouldn't it be great to have money, 8 years ago to get involved with Airbnbs before it actually got popular?
Yeah.
So, number one is everybody listening to this, 98% are going to feel behind the 8 ball like they missed it. You're not unique. The worst thing you can do is dive in when you don't understand something. So, if I were you, I would get involved with communities, groups. And Hormozy talked about this just recently on a post. He said, if I would have put all of the money, how did he word this? All of the money that he spent on himself, getting in different masterminds and education places to better himself. If he would have put that into like the S&P or the market, the value after the 8 years would be nowhere near what he was able to create for himself.
Right.
So I think when you ask that question, anybody asking that question, it's proof that they're not ready to go dive in on their own. You know what I'm saying?
Yeah.
Good question. And I would ask that to real estate professionals and real estate gurus that have a lot of doors, as they call it, a lot of doors under their belt. So where I would start, bro, is get in the right rooms with those people and
Right.
just chum it up, dude. Just hang out with them. They're
Yeah.
cool. You know what everybody's favorite topic is?
Themselves.
Themselves. So get in a room with those people and be curious.
Okay. Yeah,
And then I would put money towards buying a product. Pace Morby's got a bunch of stuff out there. I don't know if they're good or bad, so this isn't a recommendation, but there's ways to learn from some of these gurus. For better or worse, it's like, and then here's the thing: you go put $5,000 on an education, you're going to like study it probably, and if you don't get what you want, you get what I call experience. Experience is what you get when you don't get what you want, and now you can talk about, I paid for that, I didn't get what I wanted, and here's why. You know what you're doing now moving forward based on experience. The people that I don't like to be around are the ones that talk that never take action. The one that never spent $30,000 on a mastermind just to get in the right room with the right people. That person who will sit and complain and then all their money is tied up in a government controlled 401k. Sorry, dude. I'm not drinking a cup of coffee with you. It just doesn't excite me.
Well, that leads me to my next question that I actually didn't ask when we got coffee, but I've been thinking about it recently. How do you find those masterminds, and like where to go to find them, for me or anyone, and how do you get into them? So I know some are incredibly expensive in terms for like my life right now, and then others, I'm sure I just don't know about any of them. So how do you find those?
Well, It's funny. Like I'm 40 and my buddy here in the office is like 35 and he's like, man, how do we just meet more entrepreneurial minded people? And I heard a guy talk about join the most expensive gym in your town. And cause you're going to meet some people that think like you do. So that's one place to start. But for specific things like real estate or it could be crypto or whatever, I would just start online. I would start with, the social media stuff. And before I would spend money, because I've been known to pull the trigger before I should, joining something too quickly. Um, I would hang out with those people and then kind of question, do their morals align with yours? Is it more about sales of a product or is it about success? And milk it for what you can before you pull the trigger and spend the money. But when you spend the money, you got to go all in, but I think, and that's why I started the school program, the financial blueprint on school. If anybody wants to search that, it's free. But the idea is to get like-minded people, professionals, CPAs, real estate professionals, attorneys, investors, all in the same place that understand I want to grow my net worth. I want to design cash flow. I want to think independently. I don't want to be under control of the government. I want to be able to make decisions. I want to be able to provide for my family. You got to get in those rooms. So that's a cool place to start. There's a bunch of people in there that I think always, it's tough because it's an online group, like how active actually is that? Hopefully we can build it to a place where we have real events, that could happen eventually. Yeah. But yeah, man, I would start there because the next thing that in my head is like, just because you see someone over and over again talking about a topic doesn't mean that's someone that you'd want to actually go drink a beer with.
Right.
And after my experiences, I want to be able to go drink a beer. Like if I give somebody $50,000 to join a mastermind and then I see that guy in the hallway and they act like they don't know me, doesn't leave a really good taste in my mouth. Yeah. How can I give a good recommendation? And I've done that. It's like, sorry, dude, just not all about it anymore.
Yeah, I'm the same way. I wouldn't enjoy that either. Of course, you're a podcast is the answer for this question. More than that, books and your book, which I've started, by the way. Fantastic so far. Books, podcasts. You have just off the top any recommendations for someone similar to what you know of my position, or anyone who's just interested in general?
Yeah. Yep. I'm in my office. My other office at home has all my books. This doesn't have many. I would read What Would the Rockefellers Do by Garrett Gunderson. Money Unmasked just came out by Garrett. I would read Rich Dad, Poor Dad by Robert Kiyosaki. Think and Grow Rich, Napoleon Hill. The Lifestyle Investor by Justin Donalds, which is a great one. And yeah, my book, The Entrepreneur's Asset, which comes out here in a couple months. You can go to the entrepreneursasset.com and register for a pre-order. I'm going to give away some sort of gifts. I don't know what it looks like yet, but you can put your name and email there. But yeah, those books are great, dude. There's an old book that was written a long time ago called The Richest Man in Babylon. Yeah. Talks about financial principles. Mm-hmm. I think, a lot of people are interested in getting wealthy from a thing. What's the next Uber? Or I should have bought Bitcoin. Right. Well, don't live your life with regret. Don't worry about the thing making you happy, because ultimately a thing won't make you happy. Your process and how you talk to yourself will make you happy. So this is why I talk about income so much, because if you can find a way to increase your income in a way that fulfills yourself, your rate of return just went through the roof, because you can make more and more and more. And then it comes down to, where do I want to park all this stuff? And you can take risk wherever you choose. But at the end of the day, for the keyboard warrior saying my mutual fund did 22%, cool, man. Like, no one's not happy for you. But what did it do 2 years ago? It didn't do 22%. So if you want that passiveness, cool, I'm all for it. Go do it. But I would only do that if I had a place where it's like, I don't care about that money anymore, because I want to invest in experiences, lifestyle, and cash flow long before, something that will help my net worth that doesn't help my ability to go hang out with my fam.
Right. Yeah, and I think that's exactly what you just said is why I want to be wealthy. Like, I want to be able to, it's Friday, let's take the day off and hang out with the kids or the wife and whatnot.
Dude, that's what it's about. Like, this is a Friday afternoon. I have one more meeting after this and I'm going home. I want to go hang out, pick up the girls early from school, surprise them, get pizza tonight.
Yeah,
Like that's what it's about.
yeah. For me, like, don't get me wrong. A nice car or a nice truck, like, I'll always want that, but it's more about the time versus the item that I can buy. Does that make sense?
100%, man. And when I was younger, I didn't get it. I did, I wanted the money.
Mhm.
Um, you get older and you realize the time is the value.
Yeah.
It's it. There's this stupid country song. You've heard it because you're a country boy from Louisville. Uh, what the hell is it called? Um, Next thing you know.
Oh yeah.
Next thing you know, it basically starts off as a single guy, and like the second verse, he's already sending his kids to college.
Yep.
Dude, I was like a mile down the road. I was like bawling my eyes out, like I don't want to get older.
That's a fantastic song. Fantastic song.
Yeah.
So, I mean, that's all the questions that I asked you um, while we were getting coffee. That's what I vision a lot of people wanted slash needed to know because they were curious or they didn't know. You know what I mean? And I hear a lot of "you don't know what you don't know" kind of thing,
Yep.
and that didn't make sense to me before diving into this world, but it makes sense to me now. So,
You always don't know what you don't know. And this is what I was saying in the beginning about being curious for the rest of your life. Like I know this stuff really cool, but I love being curious in a room of people doing more than me or in the real estate world. Dude, I have so much to learn about real estate, about the taxation of short-term rentals and early depreciation. It's so interesting to me how you can offset income like that.
yeah,
I want to meet more people that are doing that. So I got to get in those rooms. Keep doing it, man. That's all I gotta do. I'm really glad that we got to have this conversation
sure.
recorded because I do think there's people out there that are going to wonder how policies actually work.
Oh, I think there's a lot of people. I tell you what, if no one listens to it except the people that I know will listen to it from Louisville, it's going to make an impact because I told some people and they're interested.
I
So,
love it, dude. Well, if you're listening to the podcast, thank Tyler for this. This was his idea. Leave a comment down below. Make sure you subscribe. I love talking about this stuff. I love giving power back to the consumer, getting rid of the IRS, getting rid of creditors, taking care of your family. Dude, there's nothing better than this. So thanks for having me do this, man. I appreciate you.
no, this was a fantastic time, and I think not only did I even learn more than what I did before, even if they were the same questions, but I think it'll help a lot of people. So.
Yeah. Yeah. All right, everybody. Make sure you subscribe. Thanks for listening. We'll see you next time.